Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining us. On the program tonight, the focus is on tech stocks, and in particular, I wanted to look at Audinate, which is a great Australian company, done very well when most tech companies have been smashed over the past year. But I also wanted to put a focus on a tech payments company, namely Zip. Now, what's interesting about Zip is that share price is ridiculously low, around the 56, 57 cents level, but it was once a $12 stock when buy now, pay later companies were the toast of all stock markets. Now, the analysts are divided on whether this company is heading in the right direction. And I had lined up the CEO, Peter Gray, to show up tonight, but unfortunately he had to pull out at the last moment, but he has promised to be here next week. But also, what I found fascinating was the stockbroking company, Shaw & Partners, really like the stock. Now they have a 240% view or something like that on where the share price can go, and they're saying up. Other analysts aren't as confident about what's going to happen to this particular stock. So I want to talk to Adam Dawes of Shaw & Partners to see why they believe that Zip is going to head in the right direction for shareholders. And then Rickard comes on. Paul will talk about Zip as well. He's been a shareholder like me and was, I guess, hoping that there'd be a rebound, hasn't seen it. We'll see what he thinks about Zip. Also, NextDC has a placement out there. NextDC is a great tech company. Paul will talk about that. And also Treasury Wine Estates. Is it a buy after the price has come down? That's the show. Let's kick off now with Adam Dawes of Shaw & Partners. Thanks for joining us, mate.
Yeah, it's great to be here, Peter. It's been a long time. It's been too long.
Yeah, no, because you let me down 2 weeks ago. That's why it's been a long time. But still, you're here, and all's forgiven. In this industry, we forgive pretty quickly.
Yeah.
All right, mate. Now, tonight's show was going to be all Zip. Your Zip. We had Peter Gray, the CEO, co-founder of Zip. Pete had to pull out at the last moment, so I have to give him a bit of a ribbing, but he's promised to show up next week, which of course means you're going to be the star when it comes to Zip. And I don't usually make, brokers like you stars. I tap into your hard work and your knowledge, but this is a really interesting stock. A lot of people either have lost money or were rich on Zip and at $12, and then in a disappointing episode, it's dropped down. It's what, 57, 58 cents or whatever.
Yeah.
And some people bought in maybe $1.50, $1.80, thinking this is going to bounce back, and it hasn't. It's gone down. Now, what's fascinating about you and Shaw & Partners is you really got a strong belief in this company with a 248% upside. Now, when your colleague, I know you're not the person who did this, but when your colleague came up with this number, did you ask the question, what is he smoking?
Yeah, look, we definitely asked the question as far as that price target and is it valid?
Yeah.
Because really at the end of the day, price target can be a moving feast, and we know analysts move as prices or shares go down, analysts will follow that with their target prices going down. And when share price is going up, they have to re-rate and lift their price targets. But our analyst has stayed, he obviously has reduced his share price. There's no doubt target price, he's definitely reduced that. But really what we're looking at is that quarterly numbers that just came out from Zip. And to be honest, it actually looks like it's okay. The numbers are on the quarterly now, albeit off a very low base. So we need to be really careful when we're starting to talk about these things. But transactions for the third quarter, transactions were 2.3 million, up 12% for the year. Transaction volume was 2.2 billion, up 9% for the year, and revenue was 182 million, up 15% for the year. So potentially, it looks like it's turned a corner, and we're potentially starting to see some green shoots coming back into the business. Now, why does our analyst think that this is something that you should buy or look at, and hence why he's got a buy rating and then a higher price target? Is around all of the legislation that's just now started to come out with the buy now, pay later, is that they're going to be treating it as a credit, and which means that they are all buy now, pay later people are going to have more, like when you get a credit card, you're going to have more information, more data about yourself and where you're going. And certainly that's exactly what Zip's seeing at the moment. But we always knew Zip did a lot more to onboard a customer than its competitors or its nearest competitors. And so hence why Zip is actually looking a little bit better, because all of those processes have now been placed into their systems to then allow clients to come through, as well as having that credit check going forward as well. So we also like the business because they went for a massive land grab. They went out to South Africa, they went to India, they went everywhere to try and get first mover advantage. Now they've come back and sort of pulled back on a lot of that. And, US has basically been the major focus. And certainly that's where a lot of the money, because the US is probably one of the largest consumers, well, they are the largest consumer in the world. And that's a place for them to be as well. So look, it's a tough one. Certainly US customers, they did fall by about 4% year on year. So be a little bit cautious there. But the quarterly update didn't look too bad. And I think that's what we're hanging our hat on, is if we can get a couple of quarters like that moving forward, potentially the business can, or the share price can potentially get back over $1 one day.
Yeah. Well, look, I also see a company like this, because at one stage they were certainly the second best in Australia behind Afterpay.
Yes.
And their US businesses were right up there until the PayPals of the world and all the other big tech companies started eating their lunch. All right. It seems to me then, and I'm sure you guys would have thought this one through, that they must be also potentially a takeover target, because they're bloody cheaper than they were, ages ago. Is that something that's also out there as a possibility?
Oh, absolutely. If you even look at their database, they've got over 80,000 merchants sitting on their database. Customers are in the millions. Any bank would love that kind of retail database to do that. But then also you've got these larger guys, potentially not Apple, because, and that was really, I think, the straw that broke the camel's back was Apple coming in with their pay and all the credit cards. As you rightly said, all these big guys just came in and said, we'll pay it in 4 installments, no problems, we'll be able to do it. And it sort of really then sort of took the fire out of the buy now, pay later sector. But yeah, certainly I think overall you could look at Zip as being a takeover target. One, because it does that credit so well, and that licensing, or that getting the ability for clients to get in with those credit checks. But then also the database they've got is enviable across the board for any of one of these larger organizations. And at 56 cents, the only thing that I would say about Zip that's probably a bit of an issue is that 61 million shares are still out there on the short list, which is about 7.7% of the register. Yeah. And that means 7.7 or 61 million shares. People think that the stock will go lower from here. So potentially, if there is a suitor out there, well, they probably could just sit back and wait. And if they could get this cheaper, well, then they potentially might.
But of course, when that offer comes, all those short sellers will be desperate. So it's a real punter's speculation, isn't it? But the point you're making is that the numbers aren't as bad as what the market is portraying this company as. All right, mate, that's great. You also wanted to talk about Wesfarmers. Why do you want to talk about Wesfarmers?
Well, Wesfarmers, we'll go from a small cap to a large cap here. Wesfarmers has a trading update tomorrow. Now, they're not going to come out with any profitability or capex or those kinds of things, but we're going to get a really good insight into all of the businesses that they hold. One being Catch, which is Catch Online, their one digital businesses. We're going to be looking to see how much of a loss that is still going to incur. Plus also, we're going to see they did have a data breach. So hopefully they're going to sort of start to talk to shareholders about what's going on there. Obviously, Bunnings is going to be a major part of that. And what key categories for moving as far as share growth that they're getting, one in the retail side, but in the trade side as well. We're also looking for impact on lower timber prices in Bunnings, and that potentially might have a bit of a sway on the profitability. Kmart, we're going to keep an eye on what's happening with that. We're seeing the trade down cycle happening at the moment, so that's going to be really important. The chemicals division, that's a major part. 25% of revenue comes from their chemical division, and we'll see how that's going. Recent rainfall and soft commodity prices have sort of made that energy side a little bit softer, as well as then the health side. Look, we know that Priceline, they've taken over Priceline, but also they've just made a bid or a proposed acquisition for Silk Laser. And given their healthcare side of things, I think they'll do quite well. So, look, not much been talked about in the market today about Wesfarmers, but a big investor day tomorrow. It's going to give us a good insight of what's happening. And I think, lifting the lid up on some of these businesses is going to be a really good insight for us as to whether we're going to continue to keep buying this one or whether we slap a sell. So it'll be interesting to see. We'll see some more volatility potentially tomorrow around the story.
Okay, mate. So at this point in time, are you a Wesfarmers fan?
Yeah, so anything under $50, I'm really comfortable with Wesfarmers. Currently at $48. Yeah, I'm really comfortable. I think it's a fantastic business. They've got a lot of cash. They do very, very well for themselves. Comfortable to have clients' money in that one.
Okay, one last one before we go. We'll go back to the tech story. AD8, Ordinate. I've always liked the company. I wrote about it for the Switzer report today in company with Zip. And I saw that the analyst, thinks 8 or 9% high or something like that. But then when I looked at what it's done over the last year, like it's up over 40% in a year when tech companies were smashed. And I've always liked AD8, but I didn't realize I'd done so well. Do you like this company?
Yeah. Danny, our analyst that covers this one, he said if he was to cover one stock in his whole entire life, it's Ordinate, and he loves the business. He thinks it's absolutely fantastic. That's the overall disruption of audio leads or cables into digital is just amazing. But we have seen Jefferies also come out with a update and a buy on Ordinate, which helped the stock rally just the other day on the back of that. But look, so overall, everything's annual growth rate at 7%. It still looks like things are moving really, really well with Ordinate. We did have some issues with supply chain issues coming out of China. That's all been sorted. So, overall, I think this business has a good runway. They're not just in audio. They've got a lot of visual stuff as well. They're doing a lot of things across the board. So it's not just sort of a one-trick pony, as it were. But overall, I think, analysts are fairly conservative on this one, and this thing can go higher. It's very highly held by the institutional market. There's a lot of people in there. So it doesn't have a great retail base, but that's okay because that does give opportunity for retail clients to coming in on this one. Ordinate is definitely a buy. We've got over price target over $10 on this one. It looks good.
Okay, mate. Thanks for joining us.
Thanks. Have a great day.
Great. That's Adam Dawes of Shaw and Partners. Well, Paul, you are a replacement for the CEO of Zip, Peter Gray, but it's a good quality replacement.
Thanks, Pete. Great to be here.
Yeah, and he will be attending the show next week. He promises it. But while you're here, it's good having objective analysis. You're an investor in Zip. I know you got in at a low price, and I thought you got in at the right time. But it's continued to fall. It was a $12 stock. Now it's around 57 cents or so.
Yeah, 57 cents, Pete. Look, I got in about just under $2, so not as much pain as the people at $12.
No.
I guess, let's look at why it's fallen. I guess there are really sort of two factors. One, of course, the general decline of tech that hasn't helped Zip. But more importantly, I think there have been questions, Peter, about the sustainability of its model. It did rely on rapid growth. As the economy slowed a bit, other payment forms came on board.
So a lot more competition, isn't
it?
A
lot more competition. Yeah. And then particularly in Zip's case, some of its offshore expansion, particularly in the US, has been challenging. And they've found it hard in an environment of higher interest rates, much higher interest rates. The margin they make goes down, and it's harder to get the money back. So it's really a function of all those things. And at the moment, I think the jury's still out. Is that the Australian business is by itself, I think, reasonably profitable, or at least breaking even. The offshore parts of its business are still using up cash.
And I guess the market is also anticipating the possibility of a US recession, which is not going to help a business that's been giving out credit to lower income type people.
Yeah, and that's all part of it. So, but you can't underestimate the influence of just higher interest rates because it's, effectively, whereas cash was almost free not long ago, now they're paying 4% to borrow the money, or more than that to borrow the money. So it's a lot more costly to provide as essentially free loans to the consumer.
Yeah. Do you get heartened, Paul, when you see, Shaw and Partners tipping a 248% rise. Would that put you in the money?
Look, yeah, get close to it. That'd be nice. I mean,
it doesn't take you up to anywhere near $12, does it?
Yeah, I think the whole buy now, pay later market's got to sort of demonstrate ongoing profitability and demonstrate that it can grow in an environment of higher interest rates as well. I think that's the other challenge for the industry. So, look, the other sort of thing overhanging Zip, of course, is more regulation. We had the announcement by the government the other week about the so-called middle option, which is sort of put it in the credit bucket, but not quite treat it like other credit providers.
Like credit cards.
So that was the model that Zip argued for. So I think that's probably a net positive that the government's gone that route rather than the full credit model, which would have been really detrimental to business.
Yeah, okay. The consensus is a 41% rise, but of course, I guess with a stock like this, you've got to keep your fingers crossed, haven't you? That's about all you can do at this point in time. Now, let's go. I won't discuss next DC with you, but before that, you have a view on Treasury Wine Estates, and what's that?
Yeah, Treasury Wine Estates got sold off last week on the back of a slight downgrade in earnings from the company itself, and really perhaps warning more about the fact that some of their lower entry wines in the US were struggling. Treasury Wine Estates has got sort of this premiumisation strategy. So they want to just do luxury and so-called premium wines and get out of sort of the commercial part of the market.
The cheap and cheerful.
The cheap and cheerful. And in the US, where they've got a lot of investment, and they do sell things like their Penfolds brand into the US, but they also own a number of US vineyards as well. They're perhaps towards the bottom end of the luxury brand, and that's been suffering a bit as the impact, I guess, of the economy bites a little bit. And so that was sort of the slight. We had a bit of a fall in price last week, down about $1.30 on the back of a slight deterioration in revenue and earnings. I think there's actually value again, Pete, because one thing that sort of strikes me out a little bit for Treasury Wine Estates is that it sort of weaned itself totally off China. It's getting no revenue at all out of China at the moment, and its profits gone up over the last 3 years, despite the fact that exports of Australian wine to China have been blocked.
Yeah.
So it's sort of developed new markets, done particularly well. It's actually got its house in order. It's executing this strategy to get out of the lower ends of the market. It's probably been fairly aggressive on the cost side. So I think it's a pretty well-run business. Probably the stock got ahead of itself. It was trading up near $14 just a couple of months ago, and today it's sort of back at $11.80. So I think there's good value there, Pete. Look, I'm not saying it's going to turn around straight away, but you've got to buy stocks like that, which are market leaders, category leaders, quality stocks when the market doesn't want them a little bit. And I think this is one to look at.
And they will probably get a benefit if and when China says, okay, we'll start buying your wine again.
Yeah, I mean, that certainly would be a kicker. I mean, they probably still say the US is the most important market for them in terms of that whole, luxury and premium part. But, the Chinese market is there. It's about the same size as Australia, but, it could come back quite quickly, and that would be a help across all its sort of portfolio.
Yeah. Average consensus rise is 12%. The most positive is Morgan Stanley, up 24%. 5 out of 6 analysts like it, Paul. I think only Orbinet doesn't like it, but it's only minus 3%. So, it's probably a really interesting call. Let's go to next DC now. And do you like the company, first of all? And then I want you to talk about the placement.
Yeah, I do like the company. I think they're, again, another company that's executed really well. Look, if you're not familiar with NextDC, it's essentially an operator of very high-end data centres that are used by a lot of the cloud computing, defence, big government corporates. And so if you're in Sydney, you can see one going up in Lane Cove, on the highway there at Carmen, near the old ABC studios.
Yeah,
that's currently their third data centre in Sydney being built. They've got a couple in Melbourne, one in Canberra, Adelaide, Brisbane. So this is money they're raising to, first of all, to actually accelerate the development of their third data centre in Sydney, but also to go offshore to both Kuala Lumpur and Auckland. And again, build the same type of really high-quality data centres in those markets. So I do like the company. Good story of execution, good story of growing EBITDA. Look, fairly expensively priced, but you pay for that in terms of companies with growth and quality. And I think NextDC's in that category. And so, yes, I do like the placement. So the placement was used all for expansion.
Yep.
And
Those data centres you're talking about.
They raised money at $10.80 a share. It's trading today about $12.80. And the final part of the placement is an offer to retail shareholders. I think it's 1 for 8, Pete. And I think it closes on Wednesday. So if you want to get in, you need to get in pretty quickly.
All right, for people who've never done this before, Paul, and they are shareholders, they might be with ComSec or Trade or whatever, what do they have to do to make sure they get in by Wednesday?
Yeah, so normally what the course of action is that the registry or the company will tell you that you've got an entitlement.
Yeah.
You may need to go and download your entitlement notice through the company's website or through the registry's website.
Yeah.
And then to take up the entitlement, all you need to do is pay by BPay.
Yeah.
And as long as the money gets there before the close, that'll be taken as acceptance. So the entitlement number will have your own unique reference number for BPay, and you use the BPay number and just pay the cash up by the closing date.
And Paul, do they need to know whether this is from Link or Computer Share? Because if they're going to look up...
It will be with using the company's registry. So if you go to each of the companies, NextDC has got an investor part of their website.
Investor relations?
Yeah, so go to nextdc.com, maybe .au or .com, right?
Yeah.
And look, there'll be a tab on the screen for investors. That goes to the site which is dedicated just for investors. They'll have all their details, like who the registry is, what the share price is, and probably information about how you get access to your entitlement.
And you'll probably need to know your HIN. They'll ask you your HIN.
They'll probably you'll need to know either your HIN or your shareholder reference number.
Yeah, okay. So one last thing. We saw tech stocks really come for a nice roll up last week once NVIDIA reported and did very well. And AI was the driver. Do you think this is purely an AI-driven technology recovery, or this is the early signs that tech will get more and more accepted when interest rates stop rising in the US?
I don't think it's just AI, Pete, but certainly it's big tech, and big tech, you got to remember, is very profitable and has huge cash flows. And perhaps you might have argued that why a company like Microsoft or Amazon got sold down when interest rates went up. They're actually net investors, right?
Yeah.
They have net cash.
Yeah, and
And so it doesn't really make a lot of sense, you could argue. So I think the market looked at the Apples and the Microsofts and the Amazons too hard. So I think that's the first part of the story. Now we're seeing the impact of what AI is going to mean, and I think people can see that's actually going to continue the advance of a lot of these tech companies, particularly big tech, because big tech has been a big investor in it. Right, for many, many years. I think we're going to see a bit more of a flow through to other tech companies in due course, but they'll be looking for companies that are, certainly are cash flow positive, or if they're growing quickly, there's a clear path to getting to be cash flow positive very quickly.
Yeah, so it won't be like the way one tech stock did well and the industry, everyone just sort of chased it. It's going to be a little bit more selective going forward.
My sense it's a bit more selective going forward, Pete. And but they're the growth engines, right? This is where we are in. We're not in the industrial revolution; we're in the tech revolution still.
Yeah.
So quality tech companies that are part of this are going to continue to be that are driving a lot of the share market, but both in the US and to a lesser extent here in Australia.
Okay, Paul. Thanks for joining us.
Thanks, Pete.
It's Paul Rickard of the Switzer Report. If you want to read more about what Paul's analysing, become a subscriber to the Switzer Report. That's the show for tonight. Thanks for joining us. And remember, if you want more deeper analysis on what stocks might be in the buy zone or the sell zone, think about becoming a subscriber to the Switzer Report. Go to switzerreport.com.au. Thanks for joining us. See you next Monday.